Welcome to this episode number 50 of Your Next Trade. First thing first, Happy New Year. I wish you all the best for 2024 and I hope you're going to have a very successful year in trading. So 2024 reset, we started the year the total opposite of the 2 months rally that we had in November and December. Starting with the indexes that we have here, you can see that the non-profitable tech, anything that was on fire in November and December, has been hardly punished year to date. So non-profitable tech down 7%, liquid IPO basket up down 6%, and on the other end of the spectrum, as we will see later, everything that is defensive has been holding pretty well for this week. So as always, when we start the year, you're going to see expectations for the year, you're going to see analysts, you're going to see the consensus giving you some level. Interestingly, we do know that in November and December, we had a very strong rally across asset classes, mostly with the yields going down massively. So the US 10 years went from 5% to close at the end of the year at 3.8%. And we saw for stocks a big move from 4,200 to 4,800. And that was true as well in Europe. So very strong move, not much about macro, to be honest. So the macro, the US is still, trending around 1 to 2% GDP. The economy is doing fine, but, if you look at the big picture, the US is still running a 5% deficit, fiscal deficit and above. So in other words, it's pretty easy to have 1 to 2% GDP growth when your fiscal deficit is pretty much into this level. So I would like to start with the week-to-date asset performances. Again, 4 days don't make a year, but that gives you a picture that what we had for the week. So we are down 1.5% on the S&P, 3% on the Nasdaq, and a bit more on the Russell. If you look at other assets, other markets, like in Europe has been struggling a bit, down not as much as the US, but you need to keep in mind that if you take the same number, FX adjusted, Euro is down 1% on the week. So overall, the correlation between the different stocks indexes have been more or less the same. Bitcoin flattish on the week, so crypto we had first a big move, now we are coming back. There are still the talks about this ETF that should be launched in the next few weeks. At the end, we got WTI small up 3% because of the tension in the Middle East. So we have been trading recently between 70 and 75. Copper down 2.2%. So what about the week-to-date industry performance? That gives you a better understanding of what has been happening for the week. So if you look at the S&P, you get the S&P that is roughly here, down 1.5. You had many industries that underperform the S&P for the week. And the big winners that we had in November and December, as I said before, solar, software, really underperforming. Other end of the spectrum, healthcare, pharmaceutical, utilities, pretty much anything that has been defensive has been doing pretty well. Interestingly, as you can see here, the financials have been doing pretty well. So that's something that we're going to be keeping an eye. Starting from next Friday, we got the earnings season. So that would be the Citigroup, the JP Morgan. And as we're going to see, JP Morgan has been doing pretty well. So year-to-date sector performance obviously is the same as the week-to-date. So that means our Excel spreadsheet is doing pretty well. And as you can see, again, the defensive, the healthcare, energy, consumer staples doing pretty well. Other hand, IT, consumer discretionary really struggling. So what about the rates? Rates, if we look at the US 10 years, starting with here, so the last is at 405. We were at the end of last year, as I said, around 3.8%, 3.9%. So we had a really big move that was due to positioning. A lot of options pushed the bonds higher, meaning the yields lower. But week to date, we have been up. So we are roughly 20 bips up across the US 10 years and European. So that has been the move. Now, I think this chart is really interesting because I wanted to flag what has been happening in terms of Fed expectations to the Fed fund rates between what we had as of yesterday, as of Friday close, versus what we had on the 13th of December, which was just after the last FOMC meeting. And you can see on this chart here, the red one and the blue line is pretty much the same. So over the last 3 weeks, the expectation from the Fed have not been changing that much. It's more or less the same chart. What does it tell you? It tells you that for December 2024, the market is expected to change versus Friday, of a change of roughly 1.28%, which gives you 5 cuts into 2024. We do know that the Fed dots are saying we're only going to be making 3 cuts. So that will be for the Fed. So Fed is at 3 cuts. Market is at 5 cuts. If we look at when is the next meeting where they could do something, March, I don't think it's going to be March. It looks more and more like we are talking into May or even further. So what about the VIX, the volatility? So look at this number, 13.35%. For those of you who have been trading the market for more than 2 years, you do know that the VIX, since its creation in the 90s, has been hovering around 19%. So 13%, if you look at this chart here for the last 2 to 3 years, you can see that we are at very low level. That doesn't mean that we can go lower. But we do know that what happened in 2023 was a lot of volatility compression. Volatility compression mostly due to new products, due to the economy doing well. And now there is, as always, question of how long can we compress this volatility before anything happens. So it's not coming from me. If you look at people that are smarter than me looking at options, what we had in November and December is a big move due to options, part of it. So we went to the 4,600. I thought that it will be stuck at 4,600. We went above and then we had to chase the gamma above that, and we went to the 4,800. In terms of positioning, there is not much of positioning. So if you look across the open interest, it's not like you're going to have a big pin going into the next expiry, which will be in 2 Fridays. So not much of our real positioning, and that is why we do have, like, over the last 4 days, as we're going to see later, this everyday small sell-off. So let's look into the technical analysis, starting with the S&P. So that's the S&P. The channel is still the same. The trend is still the same, as you can see here. So this is a weekly chart that you can be doing on TradingView. As you can see, this red candle, we are back more or less to the level that was on the Wednesday of the FOMC meeting. So many asset classes are back to the FOMC meeting. And that's the same with the Nasdaq. So Nasdaq, you can see this big candle. The Russell is interesting. So we try to challenge the 2100 level. And since then, we have been coming down. And we are back to this, let's say, to this consolidation between, I think we could go lower for the Russell. Russell Nasdaq picture is still the same. We are at an important level in terms of the ratio. The Facebook of this world, so the Fabulous 7 versus the SPY, sorry for my English, as you can see, the trend is still the same. So it's going to be interesting. We do know that Apple this week has been pretty weak, and that's an understatement. So we touched this important level around the 200 that was mostly driven by options, and since then we have been struggling. If you look at the fundamental of Apple, as I've been saying for months and months, there's not much growth in terms of EPS. So EPS, we are trending around $6 to $7. So you are paying 30 times earnings, not much of growth. Yes, they are generating a lot of free cash flow, but the question is, where is the growth coming from next? So other asset classes, starting with the WTI crude oil, I don't have that much of a view, as I've been saying weeks after weeks. I'm divided between supply and demand. I can't really make up my mind, so I don't take any position. Gold struggled to go above the 2080 level. Everyone is watching the same level. We tried and we failed. Dollar yen, dollar yen keeping and coming back and actually went into the 146 on Friday just after the NFP numbers, and since then we are lacking a bit of direction. So I don't want to be spending too much time on TA for today. I'm more interested is what happened for the week. So for the weeks, this is the trend of the S&P. So if you remember, before the expiry in November and December, that was the total opposite. So you will have a market that will be trending like this. Since then, we had a bit of a reset due to some repositioning of options at the end of the calendar year. And you can see the trend is each time the market is trying to bounce, then we are coming down. So trend is the same. What we are trying to figure out is what's going to happen next with the earnings season. So, and an interesting chart is this chart of Apple, JP Morgan, and the SPY. So here you're going to have in green the Apple chart, in red that will be the SPY, so SPY, and finally the JP Morgan. And as you can see, you start to see a divergence around the last expiry. So from the before the last expiry, the market was, everything was moving the same. So correlation was really, really strong. As you can see here, everything was like you didn't have to be very smart. And, when people were saying, oh no, I was long X, I was long Y, you were just long the market, you were very lucky and you made good money, but it was all the market. Since then, since the expiry, you see the divergence, at least, with the big winner, which has been JP Morgan, and one of the losers, which has been Apple, and you see the divergence. So you start to see things that are unwinding a bit. If you look now about the macro picture, so macro picture for this week, we had the NFP numbers. So on Friday, they were okay, better than expected. Keep everything with a pinch of salt because there is a lot of seasonality. January is very much distorted, but that is my bearish point. That doesn't make any money. It's more, numbers are okay, but there has been a divergence with the ISM Services employment, which went into the 43, so a big drop. If you believe in two leading indicator, that tells you that, again, ISM Services has been slowing. You can see the trend here. It is slowing. We had one of two alerts in the past. We need to see confirmation. But, if you get an economy like the US that is 70% into services, and services are pretty much close to the 50%, the recession level, that means very much that the US economy is slowing. So versus this US economy slowing, I'm interested into the catalyst. What we have is the earnings. The earnings are coming. If you look at 2024, and that's something that I will explain in details next Saturday in my 2024 trading ID generation, is the market right now is expecting for the S&P earnings to grow by 11%. If you get 11% growth expected, and in the meantime you get ISM manufacturing, ISM services that are close to 50 or below, there is a mismatch. So what we're going to have, as I said before, starting this Friday, we get Bank of America, Citigroup, JP Morgan with the earnings season starting. And as you can see into this chart, which those are the data coming from Bloomberg, the S&P 500 year-on-year expectations are for a flattish growth, quarter on quarter coming down, and you can play and put your video on hold and see what is expected to grow and what is expected to grow. But interestingly, starting earnings season starting, so that's as always around this 10th 15th of January. What about the other catalysts? So we got an important one, which is the CPI, so on Thursday inflation. So here there is divergence, and you see a lot of noise between people that are telling you goods, many inflation is coming down, rightly so, rents are coming down, but in the meantime you have inflation coming from wages. So what we saw over the last few months is you get the manufacturing inflation that is coming down, keeping in mind that you start to see some tension from the Middle East, so that means the cost could go higher again. And as well, versus that, you get the inflation services that is still pretty strong. Why? Because if wages are going up, they're going to go up for the next 6 to 12 months. So in H1, we should see some services inflation in the pipeline. interestingly, you can have to look again at it. Either you say, okay, because people are going to have more money, they're going to be spending, so that means GDP is going to be pretty good and earnings are going to be pretty good, meaning the market should go higher. And you have the other view, which is the bearish view, which is if wages are going higher, then, you know, the operating margins, the margins from companies should contract, and that means EPS should come down. So two ways of looking at it, but in terms of catalyst, so CPI, most recently, the S&P has been doing pretty well on the CPI, not much of red color into that. We do know, if we look at Europe, that there has been a rise, and that was pretty much flagged by the ECB 2 or 3 weeks ago, that we should see a rise in inflation. Now the question are the same with the CPI in the US. Are we going to see a bump? So CPI, PPI, we do have like some Fed speakers, and we do have like some US auctions. As we do know, the Treasury reduced the size of the 2 years, 5 years, 10 years, 30 years in the months of January. Why? Because they wanted to go more into T-bills. T-bills will be more expensive. There will be a reset at the end of January. So catalyst, earnings, market is in the downtrend, pretty much driven by options, not much of positioning, big positioning yet, and you have winners versus losers. So JP Morgan is going to be very interesting because JP Morgan is trading around 172, 173, made new highs. We look at the chart today versus some other players, so doing very, very well, and most of the banks have been doing pretty well, and same in Europe. So looking at drivers, what are the catalysts and what are the winners versus the losers. So this is it for me today. As always, if you are interested in learning how to trade and to invest, you could have access to the 4x4 video series. I do as well the mentoring, which are one-on-one sessions that we do on Zoom. We have a trading community where we have more than 500 traders now. We have two kind of channels. We get the free channels for people that are just joining, and we get the more advanced channels for people that have been doing either the 4x4 video series and or the mentoring. If you get questions, this is my email. I try to reply to you as quickly as possible. And finally, next Saturday, I will do my start of the year trading ID generation. So every year in the month of January, I do this webinar, which is trying to find trading ID and to put you and go through the process of the 4x4, which is something that I do every single day on my daily job. So that will be next Saturday, the 13th of January at 2 p.m. London and or 9 a.m. New York. So this is it for me today. Again, Happy New Year, all the best for this year, and I hope you're going to be joining our trading community. Bye-bye.